Section 8.4 Elaboration on Key Fundamentals, Supply and Demand. I think I put more emphasis on my supply and demand levels than you guys might initially think. Because being able to identify high probability supply and demand levels, and therefore POIs where you are expecting a rejection overall, it builds a lot of confidence in trading the TCT model because you are expecting a rejection from that specific level already. And getting a significant rejection is usually caused by getting some sort of a high probability TCT model that allows for the expansion in the desired direction. But also, when building context around my high probability TCT model, having deviations of your model tapping into high probability supply and demand levels gives you that extra confidence in the tap and the purpose of the model and the purpose of the taps within that model. So I put actually a lot of emphasis on my high probability supply and demand levels, and therefore it's going to be crucial that you guys understand how you can identify them. Okay? I want to start off with a correction of the Mentorship 2024 because in the supply and demand lecture within the Mentorship 2024, I elaborated on structure, supply, and demand as us simply identifying the last few candles of a pivot point that then leaves a fair value gap. However, I want to correct myself by saying that when I am drawing structure supply or structure demand, I am only using structure demand and structure supply when having an actual valid market structure pool and not just the last few candles of a structured move. I am always pulling my structure supply and structure demand if there is actually valid structure applying the 6 candle rule. If there is a clear structured move, but we do not create the fair value gap, therefore confirming the structure supply or demand level, but it is the only POY opportunity within that price region, sometimes, depending on the context, I will still highlight the supply or demand level on the chart, but mentally I will give it less significance. But when we're seeing this structured move, I'm only pulling structure supply here if I can validate it on a lower time frame here in red as actual structure. And the same here from a demand perspective, where if this is structured move down followed by a V-shaped reversal back up, I'm only drawing structure demand if on some sort of a lower time frame I see my valid 6 candle rule with a break leaving a fair value gap. So that's the correction I want to make before diving into our high probability supply and demand levels. So I'm always drawing structure, supply, and demand when there is actual structure following the 6 candle rule. So now diving into our high probability supply and demand areas. High probability supply and demand POIs are based upon where the true inefficiencies in the market are located. These true inefficiencies give great algorithmic reactions. What I mean with this is that oftentimes there are going to be situations where we have some sort of an order block on a higher time frame. I always want you guys to zoom in on that higher time frame order block on a lower time frame and check if there is low time frame structure supply or structure demand within that block, whether you're looking at a bullish order block or a bearish order block. Because these markets are ran, I would say 70 to 80% purely by algorithms. And algorithms love inefficiencies in the market because they tend to give great reactions once we fill and tap into those inefficiency and imbalances on the chart. When I'm talking about a fair value gap, an inefficiency, or an imbalance, it's basically 3 different words indicating the exact same. an inefficiency, an imbalance, and the fair value gap all mean the same thing, which is basically an inefficiency in the market, which we tend to use to confirm our order block and confirm our structure supply and structure demand. But when we're talking about high probability supply and demand areas, we are combining our order blocks with lower time frame valid structure supply or structure demand depending on the block. So right here, we can see that we have a daily bearish order block where we got that bullish candle and then we got the bearish expansion towards the downside, creating an inefficiency with that third candle's high there. But right here, you can see the fair value gap creation, and therefore on the daily time frame, we have a valid bearish order block. I want you to start zooming in on a lower time frame to identify the price behavior within that daily block. Because only when we have valid lower time frame structure supply within that block are we talking about a high probability supply POI. So if I go here on the lower time frame right there, and on the 4 hour as a 4 hour, for example, if I zoom in on the lower time frame like the 4 hour and we see something like this, we can clearly see that within that daily supply and in that daily order block, price is making a higher low for a higher high that broke structure back to bearish right here, creating a fair value gap on that break of structure, and therefore we have valid lower time frame structure supply within that daily bearish order block. So the bearish order block simply represents all these candles in the time span of that day. And we can see that if we zoom in here on a lower time frame, that this daily order block has valid lower time frame structure supply. And therefore this is a high probability order block because there is a true inefficiency located within that block. Maybe on the daily time frame, we have this fair value gap creation, but if that inefficiency isn't there on a lower time frame, and on a lower time frame this block is simply mitigated, which I'll show you in a second, then the block is less significant and less strong. Only when we have also valid lower time frame structure supply within that block are we talking about a high probability bearish order block. So blocks that look like this on the lower time frame, we can identify as high probability blocks because we still have that true inefficiency right there located within our supply. And that bearish and that selling pressure from the block in combination with that true inefficiency being located within it, price loves to react from those inefficiencies. And therefore, when we have something like this 4 hour structure supply within that daily bearish order block, we can see here that the low of the order block already got mitigated right there on a lower time frame where price broke out and wicked back in before going lower. Therefore, if I see something like this on a lower time frame when drawing this bearish order block, I will simply skip the daily bearish block and simply put the 4 hour structure supply on the chart because the daily block is already mitigated right there on the lower time frame and the true inefficiency is in this 4 hour structure supply. So this 4 hour structure supply represents also the selling pressure on the daily but has that true inefficiency with that fair value gap creation. So if we want to have a proper rejection, price will come up, fill that inefficiency, and then tap into that lower time frame supply to get the reaction back down. This is a perfect example, and this happens on all time frames. This can also just be a 30-minute block and 3-minute structure supply. Okay? There's that combination of validating your block on a lower time frame as structure supply. Because there are going to be situations where you have your daily order block, but on a lower time frame, your block simply looks like this, where you have the exact same daily OBIF right there with that fair value gap creation right here. But on a lower time frame, price simply looks like this. And the block itself on a lower time frame is nothing but buy side liquidity. And we don't have that true inefficiency like we had up here. Sometimes you have a higher time frame block, which on a lower time frame looks like this. Then we have that true inefficiency, and we can establish the block as a high probability order block, where if the high probability block is mitigated, we're going to be focusing on that lower time frame structure supply within that block. Sometimes, if you zoom in on the block, there's nothing but simply liquidity within. These are lower probability blocks. If it's the only block that is there within that price region, you can still put that block on your chart. You just simply give it less significance. Where when we have these order blocks, which is nothing but liquidity on the lower time frame, you want to see a tap of the block at the lower section of the block and go. If it's going to be giving a reaction, you want price to tap the block in the lower section and go. If you start closing candles deeper within the block, price is simply going to sweep all that buy side liquidity on the left. And you can already expect your block to fail without price even exceeding the supply area. So I hope that becomes clear that some order blocks on the lower time frame are simply nothing but liquidity, and therefore I am not putting any significance on those blocks. And sometimes when we're in a high probability ranging environment and I'm focusing on an accumulation and we have a bearish order block, but the bearish order block on the lower time frame looks something like this, I'm not even putting the block on my chart because the block is simply part of the liquidity trail that we're using to confirm our high probability accumulation. So when you're not seeing me put a block on the chart, it's most likely because on the lower time frame, it's nothing but liquidity. And there isn't a true inefficiency located there, and therefore there is a lesser chance of getting a proper rejection. Now, there are going to be even more combinations where it could also happen that we have our daily order block, our daily bearish order block right here, which on the lower time frame looks something like this. So instead of getting that structure supply within that block right here, where you can see right here we have that structure supply within the bearish order block, right here we can see that we have this overlapping effect where we have this daily bearish block, which on the lower time frame is getting overlapped with structure supply right here. When this is the case, where you have a higher time frame order block, which on the lower time frame is getting overlapped with structure supply, the structure supply POY is going to have the priority. And these are actually, with these overlapping effects, extremely high probability POIs. Because this block represents the selling pressure of the total bearish order block on the higher time frame, while highlighting where the true inefficiency is located between this low and that high right there. So these lower time frame structure supply POIs, when they're overlapping the supply area from your higher time frame order block, are going to have your priority. And therefore price could pull back into this structure supply and reject. Then if you stay on the higher time frame, it looks like price is simply front running your supply POI. But if you go on the lower time frame, you'll actually realize that this low right there on the lower time frame had overlapping structure supply, and that is where price ended up rejecting from. And this allows us to get very high probability refined supply areas. And for demand, it works the exact opposite way, obviously. Because it could even be the case that this 4-hour structure supply, right there on that break here, also has lower time frame structure supply creations. So this right here, this low, is simply representing the refined structure supply from this region right here. So on a lower time frame, on this break right there, price has again that lower time frame structure supply creation on, for example, the 50-minute time frame. So you have your daily bearish order block that then on the lower time frame, like the 4-hour, has this structure supply overlapping the daily bearish block. But then zooming in on the break right there on the 50-minute, we can see that our 4-hour structure supply is also already mitigated. And we have this 15-minute structure supply POI. This 15-minute structure supply POI is going to have our priority. And this 15-minute structure supply POI represents the selling pressure from the daily block and the 4-hour structure supply, while showcasing where the true inefficiency is located. And technically speaking, you could refine this down all the way to the 1 minute, but you got to be a bit rational with your refinement process, because let's say this is valid on the 15, but on the 1 minute this is already mitigated. That doesn't mean it's not high probability anymore when we're using it in a higher time frame context environment. But understanding this overlapping effect, where the overlapping POIs represent the selling pressure of the total higher time frame blocks, while showcasing where the true fair value gap creation and a true inefficiency creation in the market is, price can reject from here, and it looks like you're front running your 4-hour supply POI and your daily supply POI, but you are actually rejecting of the perfect level right there. And that daily and that 4-hour is technically also already mitigated. You just need to go on a lower time frame to realize it. So if your order block has lower time frame structure supply or demand, it makes the higher time frame block stronger because there is a true inefficiency. If the higher time frame order block is nothing but liquidity on a lower time frame, just right here, you want to see a tap and go. If you start closing your candles deeper within the block, you can expect price to squeeze through. If you have your higher time frame, or if you have lower time frame structure supply overlapping the lower section of your higher time frame order block, the lower time frame structure supply has priority because it is where the true inefficiency is located, and markets love to react of these true inefficiency levels. And then based on my experience within trading these markets, I came to the realization that the markets love to react of these structure supply POIs refined down to where the extreme and the true inefficiency is located. So whenever you have this higher time frame overlapping effect, where you have your 4-hour structure supply, but then zooming in on the break, you actually have already 50-minute structure supply mitigating the 4-hour, you can refine your POIs down to a very precise level, which represents the true selling pressure in combination with that true inefficiency. And you can get such explosive moves from such refined POIs to the point that some people probably listening to me right now are going to be trading this from a limit order perspective because they are such powerful reversal levels. I'm still working on trying to find a way where we could potentially trade these levels as just individual reactions, but that's going to be created probably later on. But when applied in overall high quality context environments, these POIs work incredibly well. Now, we have now talked about overall high probability supply and demand POIs based upon the creation of the block, where we're always zooming in on the lower time frame to see if we have true inefficiency levels on the lower time frame, validating the higher time frame block, therefore creating a higher probability POI. The other way of confirming high probability supply and demand POIs is going to be based upon location. What did the block actually do? What did price do in that environment that you are pinpointing as a support or a resistance level, or a supply or a demand POI? And this is technically extremely simple, because our high probability supply and demand POIs based upon location is simply you going to search for supply and demand POIs in areas where you can see price aggressively getting delivered. And you will find these in actual visible pivot points. So right here, we have 3 different supply POIs. Right here, we can see price comes up, sweeps the liquidity from the high on the left, and creates this, let's call it a daily bearish order block. We get this expansion towards the downside, and we get a lower high for a lower low. And in that pivot point of the lower high for the lower low, we create another bearish order block. And then along the way of coming down, we can see right here another bullish candle followed by a bearish expansion, creating an inefficiency. If we have to rank these blocks from most good looking to the least good looking from a location perspective, this supply right here is going to be our highest probability supply POI. Why? Because the block itself is located in between a pivot point, which is extremely obvious following your higher time frame structure that's making lower highs and lower lows, while this block also swept liquidity on the left. And when you have a block located in a pivot point that swept liquidity, from a location standpoint, these are extremely high probability POIs because it shows clear market maker involvement, because we swept liquidity followed by a reversal back down, where market makers could have used that liquidity, generating and filling their short orders to then reverse price back down towards the downside. Afterwards, we can see that we have a lower high for a lower low, where in that pivot point, we create yet again another order block. Now, this supply POI is also located in a pivot point, which is validated by an actual market structure pool, so it is a decent POI. But when compared to the previous one also swept liquidity on the left, being in actual the macro pivot point. This is in the pivot point that follows afterwards. So when comparing it to this, sweeping liquidity and being located in the macro pivot point is always going to be more significant than getting the lower high for the lower low afterwards. But because it's still in the pivot point, it's going to be located or going to be ranked as our second best POI within these 3 POIs. This lower POI right here is insignificant, and you will never see me use these type of blocks. These blocks right here do not do anything on the chart, and they are mainly created purely from a timing perspective, where just because we have a bullish candle in that time period, we can see a bearish order block getting created. But the block itself is not located in any pivot point and did not do anything. It did not sweep liquidity, it did not grab a previous candle high, it did not create a nice topping formation. It's just there purely based from a timing perspective, located already in expansion that was caused by a pivot point that actually had a proper bearish block right there. So when we're ranking these from best to worst, the best will always be in a macro pivot point where we had a liquidity sweep prior to the block getting created. Otherwise, it was simply in a pivot point that is also decent, but not as good as sweeping liquidity prior to the block getting created. Having a block simply within expansion towards the downside, where the block itself did not sweep in liquidity and isn't located in the pivot point, these blocks are insignificant and should not be used. So that's how I'm ranking my blocks based up on location. And then obviously when we combine these blocks with our potential lower time frame structure supply validations as discussed above, we can get a high probability supply POI from just a candle structure perspective, where our order block on a lower time frame is validated as structure supply, while also being in an actual pivot point or the block sweeping liquidity on the left. So when you combine the two, you obviously create extremely high probability POIs where you can expect price to reject. And therefore, if price creates a distribution model coming into the POI, and you can see how each tab mitigates a more refined level within the block itself, or maybe your third tab comes within that block, because you're expecting a rejection from the block, it builds conviction behind your TCT entry. Because you're expecting a rejection and you're using the TCT model as your entry confirmation. Now, lastly, I want to be talking about market maker supply and market maker demand. Market maker supply and market maker demand is simply nothing other than using your supply and demand POIs as discussed in this lecture, but the location of the block is within the third tab POI of your previous TCT model. So if we have a TCT model right here from an accumulation standpoint, which already completed itself, where we see a initial range low, we get that second tab deviation, we get that third tab, and then we expand towards the upside right there. And we have this range and this initial range low, range high, tab 1, tab 2, and tab 3 with your breaker structure confirmation. Your market maker demand is simply going to be nothing other than the valid demand creation located at that third tab of your TCT model, of your Wyckoff model. And these tend to give amazing reactions because it showcases clear market maker involvement within that POI, because it's the third tab of your accumulation schematic. So if they actually want to cause some follow through towards the upside, they will protect the positions opened within that region, and price can pull back before the continuation towards the upside. And these POIs are the most effective if price breaks out of the range and gets an immediate pullback. If we take a long time coming towards the POI, it could already be the case that the market makers already exited the initial longs opened within this area, and they're not interested in protecting their initial positions. So getting an immediate retest within your structured market maker demand POI right here after breaking out of the range is always going to be the most effective. And if you actually focus on this, you actually realize that price loves to pull back sometimes into those levels and create immediate bounces away. But your market maker demand POI is simply going to be the demand POI created at the third tab of your previous accumulation schematic, where the demand POI is going to be confirmed from a high probability perspective as discussed above right here. Okay, applying all these theories. So from a location standpoint, it's obviously an extremely high probability location, because it's the location where your previous third tab took place from an accumulation standpoint that already played out. From a market maker supply perspective, it's going to be the exact same but opposite, where you have some sort of a distribution model. Let's say you have a model 1 distribution right here that completes itself, but there is supply left unmitigated at that third tab of your model 1 distribution schematic, where you had the initial range low, you had the initial range or range high, range low, deviation 1, deviation 2, and we have create supply here that is left unmitigated. Because we have supply right there, preferably validated within the high probability rule set discussed above, when that's located in the third tab of your previous Model 1 distribution, now we are talking about market maker supply. And if price gets that immediate retest within that, it loves to have amazing reactions aggressively away. Especially when the one that have a continuation towards the downside that actually has some follow through. They can make price pull back into that region and aggressively sell off again. But the market maker demand POY and the market maker supply POY is purely based upon the location of it being in the third tab of the previous TCT schematic, where the supply and demand POY itself are established via potential high probability details discussed in here, with your block being valid lower time frame structure supply, increasing the probability of the block, and then we can refine that down to find that true inefficiency to see where we can refine our POY for that exact higher RR entry opportunity. Okay? Now, this might be a bit confusing because we're obviously using candles here made by me. We're going to be diving into live trading examples that will clear everything up even more.